Do you want to invest in real estate without any effort, research, or challenge? Then this video is not going to be for you, and I would recommend that you hit the easy button and just buy the Vanguard Real Estate ETF, ticker VNQ, which will give you instant exposure to 160 real estate stocks and has an expense ratio of 0.12% or 12 cents for every $100 invested annually and has a current dividend yield of 5%. For the rest of us, we know that REITs have been beaten down because risk-averse passive income investors have been sucked away into higher yielding treasuries, so I think there's some really interesting buying opportunities in the world of REITs. Now, many people do think that interest rates are going to peak in Q4 of 2023 and are going to take most of, if not all, of 2024 till we see those interest rates normalize. So there's a saying going around right now, survive till 25. And all that means, if this is true, is that any debt maturing through 2025 will either need to be paid in full or refinanced at those higher interest rates, which means more money is going to go toward the interest on that debt and less money that can be reinvested back into the business. So we have compiled for you, dear dividend investing viewer, a look at 107 REIT debt profiles, dividend hike streaks, and a few other interesting metrics. Now, all the data came from either simplysafedividends.com, seekingalpha.com, which, by the way, I have an affiliate link below where you can get a special discount on an annual subscription, allreits.com, or the company's SEC filings. And to snag your spreadsheet copy, click the link below, drop your email address into the box, which you will be signed up for our free weekly newsletter, and be sure to let us know which REITs you're buying right now. And we're getting smaller, and check it out. Now you can see the wonderful spreadsheet that we have built just for you. So there's a bit of data here, so all you data nerds are going to be really happy, but I think the really cool thing is going to be the debt profile. But first and foremost, we have the ticker. Any of the stars that you see next to it are ones that I think look a little bit interesting right now. And if you hover over the name and ticker symbol, that will bring you to the investors page, as we see here with innovative industrial properties. So kind of a nice little touch for you to make research a little bit easier. Got the subsector, the 5-year average yield. I hesitated to put the current yield because I want this to stay relevant for a little bit longer. So at least you can look at whatever the yield is now and compare that to the 5-year average. And then we have the 5-year dividend compound annual growth rate next to that, dividend growth streak. The AFFO payout ratio is a more accurate picture of the cash that a real estate company generates. When you consider things like property maintenance and ignoring some accounting things, it's basically like a REIT's version of free cash flow. So we like to look at the AFFO payout ratio because it's a lot more useful to look at the adjusted funds from operation payout ratio for the dividend and to make sure that that can cover it. So this is what that number is, where First Industrial has an AFFO payout ratio of 99%. So that one you might want to keep an eye on. Now we know that REITs, because they have to pay out 90% of their earnings in the form of a dividend, they issue shares to bring in more money to grow and expand the business. That's all fine and dandy if the adjusted funds from operations is also growing. Here we have the 10-year shares outstanding, the compound annual growth rate. That's all that this number is. So this is not per year. And a company like Phillips Edison, PECO, which is one of the largest grocery anchored shopping center REITs. So that's all that number is the 10-year compound annual growth rate of the shares outstanding. And then we did the same thing with adjusted funds from operation. Now you'll see a dash here, and the reason that is because that the AFFO per share, the data just isn't there. 2013 to 2020 is just not there. Same thing with the trailing 12 months. So I kind of had to piece data together, going between Simply Safe Dividends and seekingalpha.com. So some of the data is just going to be a dash. But when we look at another company, like one of my favorites here, Innovative Industrial Properties, ticker IIPR, how we look at this number, this is an important thing, I think. The AFFO per share to the dilution rate. So what is the rate that they are growing the adjusted funds from operation, kind of like the REIT's free cash flow, to the shares that are being issued on average over a 10-year period, if it is, where IIPR is a newer company, so they don't have 10 years worth. So that's why I put in parentheses the 7-year. But over the past 7 years, they've been growing shares outstanding at, 62% CAGR clip, which is a lot, but check that out. The AFFO per share has been growing at 164% clip. So they have a 102% AFFO share to dilution rate, which I think is really, really solid if they can keep that up. But it's an interesting metric as we go down. I think these are some of the more interesting ones, at least when they're positive. And then next to it, we have the AFFO per share growth over the trailing 12 months. So kind of useful. You can look at the 10-year AFFO per share CAGR, or in the case of IIPR, it's only 7 years, 164%, but the trailing 12 months is 13%. Then next, the 10-year total sales CAGR, which for IIPR, just outstanding at 152%, 7-year CAGR. Net debt to capital, interesting metric. We want to look at that. We don't want to see it too high, like over here with SBA Communications, ticker SBAC. That's no bueno, but IIPR, just a very, very clean balance sheet. One of the best run REITs that I have seen in a long time, which is why I continue to be invested in the IIPR, only 10%. The interest coverage ratio, how many dollars of operating income do they have to cover every $1 of interest expense? So one of the higher ones on our list, except for PSA down here at 16, meaning that Innovative Industrial Properties has $9.53 of operating income to easily cover every $1 of interest expense. So even if interest rates rise, they're still going to be able to cover that. They got a lot of wiggle room. We rounded up or down the portfolio occupancy. They're at 100%. Portfolio commercial real estate exposure. I think this one is interesting, that we need to understand commercial real estate is any real estate that is being used for business purposes, from what I understand. So that's most of the REITs that we see. So here you can check out the REITs exposure, and obviously anything like Lamar, which is an advertising sign company, or BRT Apartments Corp, BRT. So that is not commercial real estate, that is housing. So that doesn't fall in there. And then office space exposure. We're all worried about office space. What's going to happen with them? A lot of you want to steer clear of it. So we got office space exposure in there as well. Kilroy Realty, 95%. My guy Ryan Williams loves Kilroy Realty. Check his channel. But just something you want to be aware of going forward. And then we get over to the debt profile. But before that, we have the Simply Safe Dividend Safety Score. Again, this is just their opinion. And then we have the debt metric, which I think you're going to like. And this is going to be useful into your investments going forward. What percent of their debt is variable rate, meaning it's not fixed, meaning it's, going to float up and down. And then what percent of their debt is fixed rate, meaning that low cost fixed rate. This is what is maturing through 2025. Remember, stay alive till 25. So continuing with my IIPR as an example, 33% of their debt is variable. So that could get a little sketchy. 8% of their fixed rate debt is maturing through 2025, and we can see by the years. So through 2025, it's going to be 7%, 16% in 26, 13% in 27, and 62% of their debt matures in 2028 and beyond. So this is very helpful, I think. Find some of these REITs you're looking at. I was just talking with my guy Harris from One Penny at a Time podcast about CubeSmart, and check that out. 2% of their debt is variable rate, very low. 11% only matures through 2025. Another one we all love, Realty Income. They have 8% of their debt is variable. 15% of that fixed rate debt matures through 2025, with 9% in 24, 6% in 25. So I hope this is helpful to some of you to use going forward if you're considering buying REITs. This can be a very cool thing to use as a starting point to get yourself in that frame of mind about what their debt profile looks like. I'd love for you to let me know what you think of this REIT spreadsheet, what your favorite REIT is that you're buying right now, or what one you think you're going to be buying. And if you are a spreadsheet nerd, you're in luck, because we just dropped another one comparing 14 snack stocks. And yes, I included the liquids to find out which one might be the best buy right now when compared to itself. And if you click this floating little box next to my head, I will tell you all about it there.